Hey guys, Sean Pruitt here, president of Kingdom Exploration. I want to go over a few articles and give you 20 examples of misquoting information causing oil prices to drop, okay? And so let's look at this, start out with looking at this article here. Chinese refining data adds to bearish sentiment in oil markets. So you can't believe everything you read, but there is a tremendous amount of bearish sentiment because of China. Data is king. When it comes to a stock, it's 100% focused on faith and data. For instance, company A is very successful, but has zero reports, zero reporting. And then you have company B, who is not near as successful as company A, but they have a tremendous amount of good news and data reporting on. They're on Fox News and MSNBC, talking about how amazing everything's going. They have amazing market reports. Who's going to do better in the stock market? Well, obviously B, okay? And you know that's the truth. I mean, why are pump and dump schemes so successful, even though that it's 100% lies? Because of the fact that the stock market's purely based upon speculation and data, information, okay? If you get the wrong data and you invest based upon wrong data, or is it not going to cause you to lose? Yes, it is, okay? And so I'm going to talk about 20 examples of how oil prices dropped because the data was just simply wrong. And this happens over and over again to manipulate the markets, okay? Let's look here. So in 2008, the EIA underestimated the impact of the crisis on oil demand and leading to oversupply fears and price drops. So 2008 oil prices went from in today's prices, okay, went from $200 a barrel and dropped down to 60, okay? They overestimated that the oversupply was worse than it really was, and the demand was going to drop much more than they expected. Same thing happened in COVID, okay? China reported weak oil demand while stockpiling reserves, driving prices lower. China purposely reported weak oil demand so they could buy oil at a cheaper price, okay? China has proven to lie over and over again. I could read much. I have a lot more examples of that, but I'm not, just to shorten the video, I'm going to leave it at the numbers I have here. EIA overreported U.S. oil stock levels, signaling a surplus and causing a price drop, okay? False reports of U.S. releasing oil from its SPR contributed to bearish sentiment and price declines, okay? That's 2011. In 2012, the EIA overstated U.S. shale production growth, resulting in oversupply fears and lower prices. That has happened over and over again. They over-exaggerate shale growth. They over-exaggerate how much they expect that shale is going to produce, and they're doing it now. In 2014, EIA's overly optimistic shale forecast contributed to a massive oil price collapse from $100 to under $30 a barrel, okay? China false refining data. China underreported refining activity during the oil price collapse, further driving down prices, okay? 2016, Russia OPEC overproduction. Russia was accused of overstating its production cuts, contributing to market skepticism. So Russia lies. Saudi Arabia has lied. China has lied. America has lied. The EIA overstated U.S. shale growth, feeding oversupply fears that led to price drops. Okay, that you're going to see that multiple times. In 2017, Nigeria reported inflated production, causing oversupply fears and price drops during OPEC discussions, okay? The API reported larger than expected crude oil inventory builds, temporarily lowering prices, okay? 2018, U.S. agencies overestimated gasoline demand growth, leading to oil price corrections, okay? Conflicting reports on inventory builds led to temporary dips in oil prices. During the pandemic, EIA inflated oil inventory levels, exacerbating oversupply fears and crashing prices. Reports of potential SPR releases in the U.S. contributed to a temporary price drop. That's 2020, okay? The EIA's overestimation of demand recovery post-pandemic delayed oil price recovery, maintaining lower prices. And it just goes on and on and on, okay? The thing is, when somebody has a false report and 1 billion people see it, only a fraction of the people that saw the false report will see it, okay? And the markets move based upon data. And I'm telling you, this is all done on purpose. China wants prices to be low because they import oil. And they trade their Chinese yuan for U.S. dollar, and they buy oil. They're getting screwed because their yuan is not as strong as the U.S. dollar. So that's they lose money on the exchange and they buy a barrel of crude. Okay, that's why they're buying oil from Russia, because Russia sells it for cheaper to evade the sanctions. Okay, but it behooves China to lie about their demand. I wouldn't be surprised if China is lying about their demand right now. Okay. India, I feel like India is the only honest one. And they are, if you look at a recent article here, India is set to account for 35% of global energy demand growth in coming decades. Okay. Total Indian refining capacity is expected to increase by 22% in 5 years from current 254 million metric tons per year, which is equal to around 5.8 million barrels a day. They're adding an additional 5.8 million barrel a day capacity for refining oil. So obviously their demand is growing substantially. I mean, their GDP is growing at a rate of 6.8%. And to give relevance, I think America is like 2%. And when America is doing well, it's like 3.5%. So 6.8% is huge, especially with 1.3 billion people. And so India is growing substantially, okay? And so China BS's to keep oil prices low. America, it behooves America to keep the price of a barrel of crude low. The top 10 companies in the world control over $40 trillion worth of assets, and they know, they have the data to prove it. They know for every dollar that a price of a barrel of crude goes up, they know how much their assets erode. If oil went up to $150 or $200 a barrel and stayed there, our economy would come to a screeching halt. It would zap the middle class's savings. Nobody would be able to afford groceries. The assets, trillions of dollars of assets would be lost in the stock market, would be lost on the account of just too high of energy prices. So it behooves the governing office, whether it's Biden administration or Trump administration, doesn't matter. It behooves them to keep the price of a barrel of crude to get elected. Nobody's going to elect a governor or a senator or a president that has caused energy prices to go up to $200 a barrel. Okay. I think that's why we had a Democrat come in office after George Bush, because oil went to $200 a barrel during that time. And so politics, it behooves them to keep the price of a barrel of crude low. So the Energy Information Administration is run by a Democrat. The Energy Information Administration, the guys who report data about U.S. shale growth, who report data about oil demand, report data that puts a bearish sentiment on oil, those guys are bought and owned by the left. They're hired by the left. They're paid by the left. They are Democrats, and Democrats have a very anti-oil agenda, and they're very pro-green. There's nothing wrong with being pro-green if it's really green, okay? But we still need fossil fuels. We need oil, all right? And so look at the markets. The markets demand that oil prices remain low. The higher oil prices go, the lower the markets go, okay? The Federal Reserve, they want oil prices lower. This inflation problem is really an oil problem, okay? So it behooves every aspect of our country to keep the price of a barrel of crude. There's only a few people that want oil higher. I want oil prices higher, but not too high. I don't want the old grandmothers not to be able to get groceries. But at the same time, oil at the prices of oil right now, it's actually causing oil prices in the future to go higher, because it's not. And you have to understand the difference between conventional, which is what we've been drilling since the 1920s, and then shale. They call it fracking. All the people that don't understand, they think that shale oil has coined the term fracking, okay? But because of fracking technology, they're able to extract oil from a very tight oil-bearing formation, okay? And so shale is the most expensive barrel of oil to produce, and a lot of it you have to export because we don't have the refining capacity to refine that much shale, because we're set up for heavy Saudi crude. We're set up for heavy tar sand crude from Canada, but we're not set up for sweet crude like shale, and we don't have enough refineries, nor is anyone willing to invest more in refineries. That's why we're exporting 4 million barrels a day of U.S. shale, okay? And we're only producing, I want to say like 9 to 10 million barrels of shale a day. And so bottom line, oil at current oil prices is not very profitable for the shale guys. Conventional, very profitable, okay? And so it's not hurting guys like me that focus on conventional plays, but oil priced at 70 something dollars a barrel. It's not very profitable for shale. And because of that, it's causing shale companies to resist from the coin term that Trump uses over and over again, drill, baby, drill. The shale companies learned their lesson. It was drill, baby, drill from 2012 to 2019. They added 8 million barrels of oil to the market, and they drilled themselves out of a job. It caused oil prices to crash. We had a glut of oil. And so the reason why you're not seeing a massive increase in output is because the guys that have the power to drill, baby, drill, they're being very conservative because they do not want to drill themselves out of a job or out of business, okay? Where conventional, it's profitable at these prices. Where shale, it's not very profitable. So they're waiting for prices to come up strong, but at the same time, they're practicing capital discipline and focus on shareholder buybacks and dividends and whatnot. But here's the deal. You can't believe everything you read, everything you see. The markets are controlled by information. And the news, the stockbrokers, the powers that be, they all control the narrative. And that narrative is to keep oil prices low. It's a constant attack on oil. And that is the reason why BRICS has to come together. Number one, they can't survive from sanctions. They want oil prices to be $100 a barrel. And OPEC has done everything they can to try to push the barrel of crude up. And they can't. You look at oil at 70 and they've cut oil production. They were set to increase oil supply to the markets and they did not. They chose not to with fear that it would cause the price of a barrel of crude to drop. So when they curb their output to prop up oil prices, it makes the West more prosperous, richer, and U.S. shale companies more prosperous and richer. All the while, Saudi Arabia and Russia and these other Middle Eastern countries are cutting production, losing market share, and they're caught holding the bag. And they're tired of that. But if they form BRICS, they're not using a U.S. dollar. Now they're using their own currency. And together, they could organize a structure to where if anybody from the West buys oil, they have to buy it through their system. And now it's causing their currency to stabilize, and now they're buying oil the same way America does. When we buy oil, we're not converting our dollar. We're just buying it. You know, oil's 80. Okay, here's $80. But when you buy it with a ruble, you know, you're paying a lot more, especially if the dollar's strong. If like in Canada, same thing. And so we'll be in the same situation that BRICS is by using their currency to buy their oil at the price that they determine, because the oil price is determined based upon the stock exchange. There's two exchanges that control 80% of the world's oil price, okay? WTI attributes to 20%, which most of WTI stands for West Texas Intermediate, and that's a U.S. oil price, okay? That is controlled by the New York Stock Exchange. And then there is the ICE, Intercontinental Exchange, 60% of the world's oil supply is priced in that, okay? And that's Brent crude. And so 80% combined, okay? Well, BRICS would be their own benchmark price. And that price would purely be based upon what that group has determined it should be. In the past, before the stock market, oil was priced based upon contracts, okay? And so if you had a large airline company that went up to a large oil company, they would make a deal and say, hey, we're going to have a 3-year contract and we're going to buy jet fuel for this specific price, okay? And a lot of people would, they'll look at a bunch of real contracts, paper contracts, people actually holding barrels of oil and actually buying barrels of oil. They'll look at all these contracts and then they'll price it based upon that, versus some dude that's never seen a barrel of oil, doesn't even know what oil smells like, is determining what a price of a barrel of crude is based upon his analysis, okay? And so now the true real value, the fundamental value of crude is getting lost in the computer charts, okay? And so they control the price of a barrel of crude. They don't care that shale is not profitable at current prices. They don't care about the impact of future supply gap due to there not being enough incentive to develop. I mean, you got to give the shale companies incentive. $70 oil is not incentive. I mean, I'm making money at conventional wells are much cheaper, but these shale companies they don't have the incentive to move forward. OPEC doesn't have incentive to add oil to the market. They don't have incentive to develop. They've made it very clear, like, hey, we're not developing like we used to. So no country in the world has a lot of incentive to develop right now in comparison to if oil prices were where they need to be. I personally think that oil needs to be around $85 to $120 a barrel. You may disagree with me, but at the end of the day, oil needs to be higher to stimulate oil development to prevent us from having an oil supply price shock. So we're setting the stage for a future situation where we're just not going to have enough oil. You can't put your faith in shale. Shale is a flash in the pan. Bottom line, it's the fastest declining asset. It will decline 90%. You put that well online, it will drop to 90% of what it originally started producing by the end of the year. You can't keep up with Saudi Arabia and Russia at those numbers. It's impossible. You need more conventional wellbores. Well, we ran out of conventional in a big way. We still have conventional oil, but when you have a multi-billion-dollar oil company, there's not enough conventional deals to keep you fed. All right, guys. I'm Sean Pruitt, president of Kingdom Exploration. If you like this channel, please subscribe, and we'll talk soon. Thanks.